Imagine a collapse. Marble palaces poisoned by ambition. Barbarians at the gates. Legions fading into dust. But Rome did not die that way. Empires rarely fall from the outside. They rot from within. And the most corrosive force is always money. Rome ruled not only with armies, but with trust. A trust cast in silver, the denarius. For the soldier, it was his pay. For the merchant, a promise. For the people, hope. Money was not just metal, it was belief itself. But belief is fragile, and empires make the same mistake again and again. They trade trust for convenience. As Rome grew, its hunger grew with it. The legions demanded gold, the borders demanded defense, and the emperors demanded glory. The treasury ran dry, and Rome turned to the oldest temptation, playing with money. Raising taxes would anger the people, so they found an easier lie: dilute the silver. A little less purity, a few more coins. Who would notice? Everyone did. Under Augustus, the denarius was 95% silver. Under Caracalla, it was half. Under Gallienus, less than 5%. The coin that once gleamed with value had become a bright illusion. People felt it before they understood it. Bread cost 10 times more. Soldiers demanded higher pay. Merchants refused cheap coins. Farmers abandoned trade and returned to barter. The market, the empire's heartbeat, fell silent. This wasn't just inflation. It was the corrosion of trust. And when trust dies, laws and legions follow. The 3rd century arrived like a storm. 50 years of chaos, plagues, invasions, assassinations. Yet behind the turmoil stood a single truth: the empire's money was dying. Taxes came in worthless coins. Trade fractured. Fields lay abandoned. Desperation turned to decrees. In 301 AD, Emperor Diocletian tried to halt the bleeding. He fixed the price of everything: bread, wages, labor, and punished violators with death. But no law can restore belief. No emperor can sanctify a broken coin. So Rome fell, not with the crash of armies, but with a whisper in the mint. Centuries later, the same echo returned. In Weimar Germany, paper replaced silver. The government printed and printed until one loaf of bread cost 200 billion marks. People carried wages in wheelbarrows. Savers starved. And once again, those with real assets, land, factories, foreign currency, rose from the ruins. The pattern was eternal. Then came Zimbabwe. Different continent, same illusion. Money flooded the streets, but shelves were empty. Prices doubled every day. In the end, the nation abandoned its own currency. Reality had the final word. Today, we tell ourselves we're smarter. We have central banks, algorithms, and digital numbers, but the trick is the same. In 1971, the United States cut its final tie to gold. The dollar became pure belief, a fiat faith. Since then, debt has soared.
The money supply has swelled, and purchasing power has quietly evaporated. The bills look the same, the coins shine the same, but the value inside has vanished. Governments call it growth. They promise prosperity, even as costs rise faster than wages. They inflate away debts and call it policy. They lift stock markets while the real economy sinks. Rome did this too. Every empire pretends it can outwit reality. But when money loses meaning, society unravels, contracts fail, trade stops, armies crumble, and governments lose legitimacy. The barbarians at the gate, they're never the real cause. The real killer is always inside the treasury. So remember Rome. When the coin turns hollow, the empire does too. When money dies, civilization follows. History doesn't repeat, but it rhymes, and it always punishes those who refuse to listen.